So chapter 12 handout is on the screen. Chapter 12 agenda is on the screen. Any questions before we go into chapter 12? Okay, the agenda today is all about the adjustment process and that 10-column worksheet. The good news is, as far as the worksheet goes, the mechanics are almost the same. There'll be one new aspect of the worksheet that has to do with the inventory adjustment. So last time we were here, we reminded ourselves of why we have to do these adjusting entries. And we said that there are certain accounts that we know are not up to date. And specifically back in chapter 5, the author brought up 3, what we call deferred adjustments. These are assets that are on the books, but we know for a fact that they're not at the correct amounts because time has passed and things have been used up. Those 3 adjustments were supplies. We had to figure out sometimes how much the supplies used was, and we made an adjustment. We know that any prepaid that is on our books loses value as time passes or as services are rendered. And so we learned in chapter 5 how to do the prepaid. And then we learned how to do straight line depreciation back in chapter 5. Those are coming back. Okay, those are not the ones we're going to focus on. We'll do those as part of the exercises that we have scheduled to be worked out today. But as far as the lecture goes, I'm going to pass those by because I want to focus on these new adjustments. And so once again, I've mentioned this before, I would use these agendas as a checkoff list as you're studying for your last test. So we're first going to jump in and talk about inventory adjustments. I kind of want to give you the back view of why this inventory adjustment is needed. So the back view is, remember that when we first started talking about merchandising, we introduced a new account called inventory. But in our notes, we wrote, do not touch. And the reason is when we bought inventory, we used purchases. And when we sold inventory, we used sales. So we haven't touched this inventory account. And so what that means is the beginning inventory that's sitting in there is from last year. And so we need to make an adjustment, and we're going to do it in 2 steps. We're going to take out the old and we're going to put in the new. And again, I want to give you a big picture overview of why we need to do that. So to kind of get this in perspective, you guys will remember seeing this. This is not the first time we've looked at this multi-step income statement. This income statement is coming in the next chapter, but I want you to take a look at this cost of goods sold section here. If you want a page reference, it's page 433 in your book if you want to take a look at it, or you can go to chapter 13 and pull this up. But here's what I want to show you. We've been working on these chunks since class started. The chunk that I'm circling with my cursor is what we learned in chapter 7, how to compute net sales. The chunk that we learned on the buying side of the house in chapter 8 is right here. I'm circling it with my cursor. It was called net delivered cost of purchases. In fact, I think you guys had that on your last test. Well, here's why we need this inventory adjustment, because the largest chunk on this income statement is called cost of goods sold. It's like 4 line items from the top. Cost of goods sold is a number that is exactly what it says. If you made $549,000 in something selling these goods, GAAP says you need to match the revenues and the related costs in the same period. Well, what we've calculated so far is called the net delivered cost of purchases. Slang for that would be, this is the cost of goods that we bought. What we're after is the cost of goods that we sold. And you'll notice if you look at this calculation, even though it's in chapter 13, you can look with me, the way we get from the cost of goods bought to the cost of goods sold is by an inventory adjustment. You'll see here that here's the beginning inventory and here's the ending inventory. ending inventory by definition is sitting in the warehouse. That means it has not been sold. And so that ending inventory number needs to be subtracted out. Now that may be confusing if you haven't had a chance yet to read the chapter 12 chapter, which is probably most of us. So I'm going to walk you through it, but bigger picture is, why do we need this inventory adjustment? The answer to that is because this $52,000 that we started with at the start of the year is no longer a valid number. And so this inventory adjustment that we'll be talking about shortly takes the old inventory out. We're actually going to zero out the inventory account in a moment and puts the new physical count in. And the inventory counting and costing process is very involved. You'll spend a couple chapters in Accounting 101 talking about how to get that number. In this basic bookkeeping class, the numbers are going to be given to you and we're going to do an adjustment for it. And that'll be one of the first things I demonstrate to you. So if I go back to this agenda, we're going to take a look at the inventory adjustment, which is going to be 2 steps. Take out the old, put in the new. And then we're going to be looking at 4 different types of accruals here. One, we mentioned these yesterday. We're going to take a look at an estimated loss for the amount of money that we don't expect to collect, because not everybody that owes us money is going to pay us. I've learned this the hard way as a business owner. I used to think, when I was naive and didn't know any better, I used to think, oh, I have a really good receivables clerk. I'm going to collect everything, everybody. I wouldn't sell to someone who wasn't going to pay me back. Well, that's being very naive. Sometimes in business, the best, what's it called? Series of hard knocks, actual things that have happened to you that the book just can't do justice to. Okay, well, that's my situation with my businesses. Not everybody that owes you money is going to pay you 100% of the time. That's never happened in the 30 plus years that I've been a business owner. And so GAAP says you have to estimate that and record that on your book. So we'll learn how to do that. I mentioned this account in the last class. Unearned revenues. It is a liability account, and we said it was the flip side of a prepaid. It's when we get money ahead of when we earn it. And so we'll be talking about that adjustment today. We'll talk about the wages accrual and the related taxes, and I mentioned that yesterday too. For every company, there is a fiscal year end, and fiscal is a word that means 12 consecutive months. So not every company has a 12/31 year-end date. In fact, most of them don't. But for ease of understanding, if we say 12/31 is the last day of the year, then any wages that have been incurred in that time cutoff period prior to 12/31, GAAP says you got to match the expenses with the related revenues. And so we got to go back and put those wages on the books. You'll see us do that today. But not only do you got to put the wages on the books, you need to put the related payroll taxes on the books. And I saw that many of you have already finished chapter 11, which made my heart very happy. So you're working ahead of the game. That means you can devote your time to the 2 toughest chapters, this chapter and chapter 13. So we'll demonstrate how to do that. And then last time we were here, we also talked about the fact that most of us aren't debt free. In this country, it's very common to borrow money to buy assets like cars, like homes, things like that. So for businesses, they're the same way. Much of the equipment they buy, the vehicles they may buy, the buildings they may buy, there's debt incurred on them. So going back to that matching principle, GAAP says you have to match up the related revenues with the expenses. So what that means is on 12/31, if we use that as a cutoff date, if there's any debt on your books, we need to make sure that the interest up until 12/31 is listed as either an expense if we owe others money, or as interest revenue if somebody owes us money. We're going to practice that today. And then the last thing we'll do is we will do at least part of one big full worksheet again. Again, the worksheet mechanics are not very different. The only exception to that will be this inventory adjustment on the worksheet that we'll talk about today. And we got a full day ahead of us. So I'm hoping that you guys at least scan the chapter like I asked you to do if you could find the time. And then we'll go over these on the handout. So that's where we're headed today. Let me stop for a second, come back in there, make sure that there's no questions. Okay, Giselle's in here so she can help me watch the chat room. Any questions on anything we've covered or anything that you see ahead of time? And let's keep going. So here's the handout. We're going to focus on the new adjustments. So last time we were here, we took a look back at where we've been and we took a look ahead at where we're going. We are now in the final stages of finishing up the accounting cycle, but this time it's for a merchandiser. So one thing I would ask yourselves right now, could you list those accounting cycle steps again? For example, first we analyzed transactions, then we journalized transactions. That journal was a great book, a great diary of all the economic transactions that had happened, but there was a problem. And the problem was it didn't track the balances. So we learned how to post to this book called the General Ledger. And once we got that general ledger squared away, then we did a trial balance to make sure that the debits and the credits were equal. And that was the start of our worksheet. And we learned previously that that worksheet was an internal tool used to pull together all the data and to give the owner a preview of what his or her financial statements will look like. Okay, that's where we are in the accounting cycle. But because we're dealing with the merchandiser, not only do we have those 3 old adjustments that we've learned in chapter 5 already, we now have a bunch of new adjustments. And so this is where we're going to pick up today. And so inventory, I showed you what the income statement's going to look like in chapter 13. And we said the biggest calculation on that income statement was something called the cost of goods sold. So what we're used to seeing is that net delivered cost of purchases, that's the cost of purchases bought. To transition that into cost of goods sold, we need to do 2 things. We need to take out the old inventory and put in the new inventory. And so if you think about it, we already know that inventory is an asset, and we know that we didn't touch it during the year. And so what we're going to do is we're going to take a look at a T account. Since the inventory has a debit balance, we're going to wipe it out. And the way you wipe out something that has a debit balance is to credit it. And remember that old account called income summary? We called it a junk drawer before. We said it was temporarily used to hold numbers and then it goes away. Well, it's going to help us in this inventory adjustment. So we took out the old inventory here and we put in the new inventory here. And I'm going to demonstrate that to you in our first exercise. But here's what some people do. And I think I was in this seat too when I was learning about accounting. If I knew that there was 25,000 in inventory and I needed to adjust the inventory to be 28, what this brain would have done way back when I was in school, I just would have said, well, hey, the difference is 3,000. Let's just make an adjustment for 3,000. But the reason that doesn't work is because you saw on that cost of goods sold, let me put it back up right here, that we don't need just the 3,000 change. We need beginning here and in an ending inventory here. So we're going to do it in 2 steps. Do not shortcut it. Do it in 2 steps because both beginning and ending inventory is going to be needed in the largest expense calculation in the book called cost of goods sold. So we're going to do that in 2 steps. Let me get my handout back up here. That's going to be our first one, and I'm going to demonstrate that shortly. Second one, we touched on this last time. Okay, unearned revenue. I would say that out of this chapter, this, along with the interest adjustment, causes the most confusion, mostly because students don't take enough time to realize that this unearned revenue account is a liability. Okay, and the reason it doesn't look like a liability, we mentioned this last time, is it's missing the word payable in it. Excuse me 1 second. I'm sorry I have to do this. So unearned revenue is a liability account. So it's going to have a normal credit balance. So what happens is if you receive income ahead of when you earn it, it goes into this liability account. The adjustment is going to be recorded as the money is earned. So in this case, if we look at this example, this is for a sports enterprise. It says, so assume that we are owner of the Dodgers and we get an amount of $1,000 in season tickets. I know the Dodgers are much more expensive, just for example here. When the Dodgers get that money in, they would debit cash, right? Because they're getting a check, and they would credit this account called unearned revenue, or in this case, unearned ticket income. Why is that a liability? It's a liability because, as we found out last year, if games can't be played, then the money needs to be refunded. Another example of this that maybe you can relate to, I'm a CPA, or I could be an attorney too. If you send me a retainer, let's say you send me a retainer of $1,000 to get some legal work started or some accounting work started. If you send me $1,000, this is what I'm going to do: debit cash and credit unearned revenue, because I've done nothing to earn it yet, but I have your money in my hands. That's why it's a liability to us. If something were to happen and I would not do the work, I would have to refund that back to you. That just gives you some perspective on why that's a liability. In class last time, I said it's the flip side of a prepaid, right? What that means is if you were paying me that $1,000 to go back and do tax returns or something, it'd be a prepaid on your side because you're paying for something ahead of time, but it would be an unearned account on the receiver side. That's what I mean about it being the flip side of a prepaid. And so what happens when you have these liabilities on your books, at the end of the fiscal year, you need to take a look at how much of that has been earned and make the adjustment to take it out of the liability and to put it into the regular old revenue account. So in the example on the handout, it says, assume that 40 games have been played. And if we go back here, 50 games for $1,000 would be $20 a game, right? So if 40 games have been played, we would have to multiply the 40 games by 20 to get the $800, and we would have to make an adjustment for that. Remember what the adjustment process is about. The adjusting process is we know there are certain accounts that are not up to date. Previously, they were all asset accounts, right? But now that we're talking about a merchandiser, we're expanding our wealth of knowledge here. And so not only do the asset accounts need to be adjusted, but here's an example of a liability account that needs to be adjusted. And so we're moving the income that has been earned out of the liability and putting it into the revenue account. So any business that receives cash ahead of when it's earned is going to have this adjustment, this unearned adjustment. And we'll do several examples. Any questions on that? Okay, then we talked about this one last time too. I mentioned that this is from the School of Hard Knocks for me. I used to think that I could collect any amount that was owed to me from a business transaction. We know from real life experience that that never happens, that no matter how careful and no matter how conservative you are in extending credit to someone, that there will be those people that don't pay their bills for whatever reason. Gosh, I've had all kinds of people. I've had some people die. And so the money that they owed me, I either was going to write it off as a loss or I was going to have to take their estate to court. There's been other people that have just fallen upon hard times, and you try and you try and you try, but they don't have your interests at heart. They have their best financial interests at heart. And And so we'll learn about how to do this adjustment. This adjustment is going to create two new accounts. There's an uncollectible accounts expense. And then here's a brand new account that I want to take a moment and talk about. Allowance for doubtful accounts. Here is a brand new account. It is a contra asset. You might be saying, well, why do I need that account? In other words, if I'm telling you that, hey, our accounts receivable is overstated on the books. Why is it overstated? Because you're never going to collect 100% of it. Well, to me, when I was learning about this, my brain would say, okay, why don't you just credit accounts receivable? Why do we have to create this funky new contra account called allowance? This goes back to that subsidiary controlling relationship, right? I don't know specifically which customers may not be able to pay me. So I can't go in and touch accounts receivable because I don't know which subsidiary account to use. And so instead of doing that, we create this new account called Allowance for Doubtful Accounts. It is a contra asset. It's going to have a normal credit balance. And we use this to reduce the amount of accounts receivable on the balance sheet. Here's a word I want you guys to know for the test, down to their net realizable value. You'll hear that often referred to as an NRV, net realizable value, which means our goal is to take accounts receivable and reduce it to what we realistically expect to collect. There are 4 GAAP approved methods on how to do that. We're going to learn one this semester, and when you guys take 101, you'll learn the other ones. But we'll come up with a number. It'll be super easy because they're just going to give you a percentage to use. And again, we're just introducing you to the world of accounting. The goal will be to put the expense in the same year as that related sale because of that matching concept, and to write down the accounts receivable through the use of this contra account. Again, we're going to get our hands dirty, and I'm going to walk you through each one of these adjustments. And then the last set of adjustments are what we call accrued expenses. There's going to be three different ones. The first one is related to wages. And I already used that example in class last time, that whenever 12/31 comes around, whatever we owe our employees on that date, whether it's for 2 days of wages or 3 days of wages, depending on when that fiscal year ends, we got to put that expense on the books. Why? Back to the matching principle. Our employees have been working hard to help us generate sales during that period. Since the revenue's on the books, the related cost of their work, called wages or salaries expense, also has to be on the books. And in addition to that, not only do the wages have to be on the books, but these 4 payroll taxes that we've been learning about in chapters 10 and 11 need to be considered. And so not only will we accrue the wages, but we'll accrue the taxes related to the wages. So let me stop for a second. It's a whole lot of new material. Any questions on those adjustments? And again, I am going to demonstrate each one of these. Okay, then the last one is interest. And we need to accrue interest on monies that we owe. That's going to be interest expense. And then on the flip side, if anybody owes us money, we need to put that interest revenue on the books. And so that's a lot of new stuff. So the only other new thing in this chapter is going to be the old worksheet. That's coming back. But with all this new data going on, the worksheet will become a little bit more complicated simply because our vocabulary of knowledge has become more expansive. So the worksheet in relation to that is going to have more accounts, more adjustments. The mechanics will pretty much be the same with the exception of this inventory adjustment that I'm going to show you. So that's a lot of new stuff. We introduced it in about half an hour. I'm hoping and praying that you guys at least scan the chapter. That would have made this much easier, but if not, we'll work through the adjustments. And then this weekend, you guys will have enough in your knowledge bank to completely finish the chapter 12 homework. It's not officially due this weekend, but it's really important so that you don't become overwhelmed next week when we have our test, that you get as much as you possibly can done with Chapter 12 this weekend. I would like next week just devoted to two things, Chapter 13 and preparing for that last test. In a regular traditional class, we'd have a couple projects, but because this class goes so fast, I took the projects out for this class. Okay, then again, I want to give you guys a chance to ask questions. If you have questions, I guarantee you there's probably 20 other people out there watching the video later in the day that's going to have the same questions, so please feel free to ask them. Not hearing anything then, and Giselle, I can't even see people's faces right now, so I'm going to assume that you'll speak up, Giselle, because I can't
Yes.
see anyone's faces. Okay. Nothing in there?
No, there's nothing in the chat.
Okay, thank you. All right, let's jump in and try these. So I'm going to go to the Chapter 12 Day 1 handout. And right before class started, I just put a couple T accounts in here to help me with explaining how to do these. So if you don't know how to make a T account, there's this lines button up here. And so I'll make one right in front of you so you can see it. If you highlight a couple of cells, then you can go pick the down arrow or the bottom border, I'll call it, here. And then you can just go right in the middle of it and highlight the area and click a right border. That's how you can make a T account. I know some of you take notes by hand. That's okay too. But once you get that, you can copy it and paste it so that you have two T accounts. Let me get rid of that. And I reminded us why we need to do this adjustment. So the reason that we need to adjust inventory is because what's sitting in this account, and I was going to use a T account to demonstrate, what's sitting in this merchandise inventory account is what was left over from last year. Okay, remember, I'm going to call this beginning. Remember, we haven't touched this account. So I'm going to get that into your notes. We have not touched inventory at all during the first 12, 11 chapters of the book. Because when we've purchased merchandise, we used purchases. And when we sold merchandise, we used sales. Okay, so we haven't touched it. What does that mean? Whatever we started with is still sitting in here. GAAP says that you have to adjust your inventory, and we're using what's called a periodic system. So we have to adjust inventory on the last day of the fiscal year to whatever the physical count is. And as I mentioned earlier during the lecture, the physical count is a complicated topic. You have to count the inventory and cost the inventory, and there's lots of accounting methods that you can use to do that. So for this beginning class, they just give it to you. They just say inventory is 116,500. Now, some of you may be tempted to take a shortcut. Here was my mentality when I was sitting in your spot. I said, well, if inventory is sitting at 121,000 and it needs to be reduced to the 116,000, I'm just going to do a shortcut. I'm going to say that the difference between that is, I think it's 4,500, and I'm going to shortcut it and make one entry. Okay, if you do that, you're going to bomb the financial statements. We don't want to shortcut it. So no shortcuts allowed. No shortcuts. We want to do it in 2 steps. Take out the old and put in the new. Okay, so I'm going to do it. To take out the old, if this is sitting at 121,000 and I want to wipe it out, what I'm going to do is I'm going to credit that account for 121,000 to zero it out, and I got to put it someplace. So back comes this good old account that you have learned about in the past. We likened it to a junk drawer, and we're going to put it in the income summary account temporarily. So what we just did, let me fix my slide error there, and I'm going to make it red. What we just did on that red entry is to take out the old. Let me write the journal entry over here. You see it visually. So the only way we can get transactions into the accounting records is by doing journal entries. Journal entries are the way that we get information into this information system. So what we just did right there is we debited income summary and we credited merchandise inventory to take out the old. So that's going to take out the old inventory. And that was for the 121,000 that this problem said existed. Let me give you a second to write that down. And what I'm hoping that you'll see is that now our inventory account is down to 0. So we're going to do it in 2 steps. We're halfway done. We just took out the old. Any questions on that first step? I guess I can put the word credit in here, so that'll be more self-explanatory. All right, if I go back to my T account, notice this now has a 0 balance in it. Okay, perfect. I've now wiped out my old. They said the new count was 116,500. So I'm going to put that 116,500 back in here. And I'm going to make that a different color in your notes. At least I'm going to hope to, so that you can see what's going on. Where am I going to put that? I just saw that I debited merchandise inventory. I'm going to go credit this dummy account called income summary with that same value. So here's the second part of that entry, the green part of that entry. What did I just do? I debited merchandise inventory and I credited income summary for 116,500. And if the color coding helps you see it, I know it helps me see things. Let me take a moment and color code these journal entries as well. And what we just did to put in the new physically counted and costed inventory. Now that brings up an issue. You might be saying, well, hey, don't you need to clean out that junk drawer like we learned previously? There are balances in this account now. Those balances represent the beginning inventory and the ending inventory, and we will take care of that when we go through the closing process in the last chapter. So I'm going to write that in your notes. These remaining balances will be closed in chapter 13. So we'll deal with the fact that there are some existing balances in the income summary and one of the last steps of the accounting cycle. Questions? Okay, then if you don't have questions, I'll move on. If you do have questions, I want to make sure they get answered. So let me give you another minute. And while you're doing that, I'm going to take care of something here. And if anything I said is too fast or you need something explained to you again, then ask away because we can do that. All right, let's move on then. Let's go take a look at 12-3. I'm going to give you guys a second to read that. And I'm going to take care of something. It's so frustrating when I have people working here at my house. Okay. All right, let's read. Adjustments for uncollectible, depreciation, and payroll. So it looks like this is going to be a combination of new and old, because I know we've done depreciation before. So these are examples of all the adjustments. I think the hardest part for you on this chapter is going to be all these new adjustments. I really don't think the worksheet's going to be too bad. We'll take a look at the review sheet before we leave class. I have a feeling that I gave you a 10-point test question on the adjusting entries, and it's probably most similar to the very last problem on this worksheet. So there's just kind of a sprinkling of all these adjustments in today's lecture, and then I hope to do a complete worksheet as well. Okay, let's read through here. Letter A says during 2001, first of all, always make sure you know what the cutoff date is, what the last day of the fiscal year is. So for this one, they have a regular calendar year. It's 12/31. Okay, not all companies have that, so you'll want to make sure you read really carefully. I think a worksheet we're doing later may have a different fiscal date. We'll see. So A says, during the year, Alenikov had net credit sales of $2,020,000. Past experience, either at her company or from data that she's looked up, shows that 1.5% of the net credit sales result in uncollectible accounts. Okay, so I'm going to go through here and I'm going to show the adjustment letters in red. And what we need to do on letter A is figure out how much of those net credit sales are going to be uncollectible and make that journal entry that we just finished looking at on the handout. So the net credit sales for her company, that means the sales on account that she made during the fiscal year, was $2,020,000. And the rate of uncollectability, it says, was 1.5%. If you don't have a percentage key on your calculator, move that decimal 2 to the left, and it would be read as 0.015. So first calculate it. I'm going to take that 2,020,000, and I'm going to put that 1.5% in there. It looks like I missed my multiplication sign. So that's what I just did. You guys may be doing it on a calculator. You may be doing it on Excel. When I do that, I got 30,300. Giselle, did you get that too? Yeah.
Yes, I did.
Okay, thank you. So then that means that based on that estimate, we're not going to collect $30,000, which again, for an owner is a huge hit, but it often happens. And so GAAP says you got sales on your books. You have the revenue there of over $2 million. We need to match the related expense in the same period. So all of these would be dated 12/31 of whichever year. They call it X1. And here's the journal entry to record that. Uncollectible accounts expense, brand new account. And then that funky, weird contra asset account called allowance for, I think they use the wording doubtful accounts. Let me go check that. I want to use the same account they use. Allowance for doubtful accounts is right. Allowance for, let me go fix this. Doubtful accounts. How much? 30,300. We just figured it out. And your directions will tell you to omit descriptions because Connect cannot double check them. I remember that I am leaving a historical document that others will follow and look at later. I always leave descriptions. So for your notes, my description is going to be to record the estimated bad debt based on 1.5% of net credit sales. I was looking for the proper wording that your author used. Okay, first adjustment. What does that do? does two things. It puts the expense on the books in the same year as the sale. That's the first thing it does. And the second thing it does is it pulls accounts receivable down to its net realizable value. So what you're going to see in chapter 13 is you're going to see how accounts receivable would be shown on the financial statements. Just kind of a little heads up on what to expect. It'll show whatever's sitting in accounts receivable, and then right below it, it'll say less the allowance. And that number will be used to bring accounts receivable down to its NRV. That's a word I want in your vocabulary for next semester. Down to its net realizable value, what a company can realistically expect to collect. It's an estimate. We never hit it exactly because you guys know this, life happens. There may be one or two more people than we're expecting that don't pay. And on the other side, it may be a good economic time, which is certainly not the case right now, but it may be a good economic time, hopefully in another 6 months when the pandemic is completely, I hope, gone and people start going back to all their normal activities. We'll probably see the net realizable numbers start to creep up. That percentage, that 1.5%, hopefully will go down and the net realizable value will go up. By the way, that 1.5% is not near what it will probably be at for current circumstances. It's going to be much higher. And you'll learn about that in 101. Questions on that adjustment? All right, letter B, equipment bought by Frankie. That's my office mate, or was my office mate. He just retired. By Frankie for $42,500. So there's my cost. This year has an estimated life of 8 years. There's the life. And a salvage value of $3,500. They want you to prepare the adjusting entry. Okay, so all the dates are going to stay the same. I think what I'll do is I'll put the account up here. I'll put depreciation expense and the accumulated depreciation, but then I'll compute it as part of my description. Okay, so this is an old one. This is what we call a deferred expense. The reason we call it deferred is because the asset's on our books and we're deferring recognizing the expense until it's been used. Well, now 1 year's worth of time has passed. And so our goal is to put 1 year's worth of depreciation. So here's the journal entry, a debit of depreciation expense to, what was this for? Equipment. And a credit to accumulated depreciation, another funky contra asset account that we learned about for equipment. And down here, we'll do the calculation. Okay, what they told us is that the cost was so much. They told us what the salvage value is. I'll go gather that data in a second. That will give us our net depreciable cost. And then I'm going to divide that by the expected life. Let me spell life correctly. And that will give me, when I do that, my annual depreciation. So I think what I'll do, so we don't have to keep growing up and down, I'm going to move this down with me as we go so we can read it together. We're doing letter B, so I'm going to go fill in these blanks, and together we'll figure out how much depreciation will be. So that cost was $42,500. That was right here. That salvage value was $3,500. When I take the difference between those two, I'll have the numerator in my depreciation calculation. That's what we term its depreciable cost. That's the most depreciation we'll take on the item. It mentioned that it had an 8-year life, so we'll divide by 8 years. And when I do that, 39,000 divided by 8, I got 48.75. We held it for the entire year. And so our journal entry will be for 48.75. I'll go back up here and put the amounts in. I don't know if it lines up with your other amounts. I guess it doesn't matter. And that would be depreciation for 1 year's worth of time. And how do I know? You got to be careful because sometimes they'll have you do it by month. This says for the year ended. Some companies will record it every month. This company, they probably are unsophisticated. They wait until the last day of the fiscal year, and probably an accountant comes in here and computes that. Okay, that's an old one. Any questions on A or B? Okay, then C says, on December 31st, Maloney, who is another accounting instructor, owed wages of $12,200 to its factory employees. Okay, so GAAP says you got to record revenues and all the related expenses in the same period. They didn't tell us how they calculated it. They made it easy. They just said, hey, you owe $12,200 to your employees. Okay, great. We need to put that expense on the books. So you can use either wages or salaries expense. And because we owe these wages to our people, that is a payable. We'll use wages payable, brand new account. I don't think we've used that before. And we'll do it for the full amount. They told us $12,200. Okay, so let me change the way those look so they'll be neater for you. And what we just did to accrue the factory wages. And then I know what's going to come right after that. I hadn't looked at this yet, but we know if there's wages, there's also going to be taxes. And if we look at the last two, it says just that. It says accrue, put on the books, the Social Security and Medicare taxes, and E says do the state and federal unemployment. And they give us all the rates, just like I'm going to give you on the test. And so I'm going to do D and E together because I think that it will go best with the way you learned the material. So I'm going to pull that down so we can take a look at it. We don't have to keep scrolling, breaking our necks, going up and down, or draining your eyes even more than it's already drained. So what we're going to do on that one is what we did in Chapter 11. So you'll remember that in Chapter 11, we had one debit to payroll tax expense and 4 credits to those 4 different taxes that the employer pays. Okay, so one big debit to payroll tax expense and 4 credits. I'm doing D and E together. So I'm going to put these in the order they were given to us, but there is no special or correct order. You can put them in any order. So here we go. Social Security tax payable. Then we'll go compute them once I get the accounts in. Then they gave us Medicare next. Then if we keep reading on letter E, they gave us FUTA and SUTA. So this is really a review of what we did in Chapter 11. So I'm going to leave myself a yellow blank. And once I get these 4 taxes computed, I can go fill in that yellow blank. So basically what D&E says is that $12,200 in wages, you got to accrue taxes on it also. So let me put the calculations down. 12,200 times the rate they gave us. Medicare will be 12,200 times the rate they gave us. FUTA will be, as long as all of it was subject to tax, yes, 12,200 times the FUTA rate that they gave us, and then 12,200 times the state rate that they gave us. So once I calculate those, we'll be ready to add them up and throw them in. You can do it on your calculator or you can let Excel do it. You guys know that I transpose numbers. Thank God we have Giselle here to check me. Okay, that's what I got for Social Security. That's what I got for Medicare. That's what I got for FUTA. That's what I got for SUTA, but I realized that I may be able to do that quicker than you may be able to do. So let me give you a minute. And if anybody gets something different, it doesn't have to be Giselle. Speak up. We'll double check. And when I add up those four numbers, I'll have my payroll tax expense. This is from Chapter 11, which says employers incur 4 taxes. The same ones you see listed there. 16, 65, 30. Okay, Giselle got the same amount. So if both of us got it, we're probably good to go. There's a couple more adjustments I want to go over, and then we'll go attack that worksheet. So that was kind of a mixture of some old and some new. A was new for bad debt. B was the old one, depreciation. We're pretty good at that by now. And the last 3 were wages and taxes. That whole adjustment process, remember what happens if we mess this up. Every single adjustment that we're doing affects an income statement account and a balance sheet account. So if we bomb it, all 3 financial statements will be wrong, just like it was back in Chapter 5. So we want to be really careful. This is a challenging chapter. I think we've talked about most of them. We haven't addressed the unearned yet, which we will, and we haven't addressed the interest. So I think the next one is going to address the interest. So not hearing any questions, either from you guys, just unmute yourselves, or via the chat room. Let's go take a look at not the next one. We're going to skip this one. So I put in here, we're going to skip this one during the class lecture, as all of these adjustments are covered on other problems, right? If I go look at this, we're going to do an interest calculation in just a minute. The supplies we're good at by now. The prepaids we're good at by now. And here's another prepaid. That's why I'm choosing to skip this one. So let's go to 12-6 and talk about interest. Okay, this is probably not the first time you've heard of simple interest. We are usually, as students, we're very familiar with debt. At least I was when I was a student. I didn't have parents that could put me through school, so I had to put myself through school. And along the way came student loans or loans from the bank. And whenever we have debt, interest is the cost of borrowing money. So way back in probably 7th grade or so, you learned this formula that probably looked like this. It was principal times rate times time. So we're going to go through those components. Principal is the amount of money that you borrowed. Okay, so I'm going to read through this problem, and we're going to go through those 3 components. And when we multiply those 3 components together, we'll get the total amount of interest that either we owe to somebody else or somebody else owes to us. In this case, it says we are the ones that owe the money because we have a note payable on our books. They might have bought a car, piece of equipment, something. They have a note payable, which is a formal written promise to pay, kind of like an IOU, of $72,000. So that's the principal. So in my formula here, I'm going to have 72,000. So we got to keep reading to find out what the interest rate is. It says the amount represented funds borrowed on a 6-month 6% note. So my rate is 6%. If you don't have a percentage key, that would be 0.06. So I have my principal, 72,000. I have my rate. It's an annual rate. It's 6%. So the T is what students mess up. And so I'm going to come down here and I'm going to write out what the T represents. The time is the amount of time from the date the note was signed until the last day of the fiscal year. So I'm going to tell you what this is once you write that down. We'll talk about how do you get the time, and then I'll tell you the big mistake, the biggest mistake I'll probably see on the test related to this and to time. So I'm going to read through this again. They have this $72,000 note. It's a 6-month note. Okay, it doesn't matter how long the note is. That's the mistake that people make. It has nothing to do with the term of that note. What the time represents is how much time has passed since the day you signed it, which was December 1st, through the end of the fiscal year. Okay, this is a regular fiscal year, a regular calendar year, 12/31. Since we signed it on December 1st, this represents 1/12 of a year. Where does that 1 come from? This is what everybody messes up. That 1 is 1 month. It's the amount of time that has passed since the note was signed until 12/31. We signed it on December 1st. Our year end ends on December 31st, 1 month. This is an annual rate. So what we're expressing here is what portion of that annual rate has expired. The answer is 1 month, 1/12. The 6 does not go in. The 6 month here is not what we use. The number 6 for the 6 months is not used anywhere in this equation. It just means that when you pay this note off, you're going to be paying 6 months down the line. But it doesn't affect this calculation because 1 month's worth of interest is what we need to accrue. So it's usually easiest if you go backwards on your calculator, which means when I do this on my calculator, I'm going to go the opposite way of how we usually read. I'm going to go from right to left. Don't round until you get to the end. So when I do this on my calculator, I'm doing 1 divided by 12 equals, but don't round, times 0.06 equals, but don't round, times 72,000. Do that on your calculator. This is where you might need to round. I got $400 when I did this. So I'm going to wait a second and give you guys a chance to do that. Give Giselle a chance to check me while I pull something that I did up this morning. And I think I got something different. So let me try one more time. Computer has kind of temporarily, okay. I'm going backwards. 1 divided by 12 times 0.06 times 72,000 with no rounding until the very end. That's better. 360 is what I got. 360. Okay, this is money that we owe to somebody else. How do I know that? This word payable. This is some debt that we owe. GAAP says you got to record the interest. So we would date this the last day of the fiscal year, and then we would put the interest on our books. Interest expense and interest payable. GAAP doesn't say you record expenses when they're paid. That's not what it said. If it said that, we wouldn't have to put any interest on the books until the 6 months are up and we paid that note. It doesn't say that. It says record expenses when incurred. We've incurred 1 month of interest, so we're going to record that $360. This often confuses students, so ask questions, please, if you have them. Okay, principal times rate times time, and time is what confuses students. They'll want to look at that 6-month note and somehow work that into the calculation. That's not the way interest works.
I have a question.
Sure.
So if we were calculating 2 months, that one would be a 2?
Yes. So Brandy, if that note was signed on November 1st instead of December 1st, we would owe interest for November and December. That number would be a 2. It would be 2/12.
Okay. Thank you.
Yeah. I want to make sure you guys understand that, because what Brandy just asked is a very intelligent question and it's often missed. So I want to make sure you guys get this. If I would have signed that note on October 1st, how many months would have passed? I'm not afraid to get my fingers out. I hope I don't have to put my feet up here. October, November, December. If we sign that on October 1st, October's gone, November's gone, December's gone, we would be multiplying that by 3/12. Anybody else? Okay, I'm going to go do our last one before we jump in and try our big worksheet for the day. Let's go to 12-7. And I wanted to make sure I covered the unearned stuff with you, because that often causes issues. So I'll make this a little bit bigger for you to see. And we may, if we see something that is repetitive, we may skip over it because I want to get to that big worksheet, but let's read. It says on December 31st, here's the note receivable account. So now this is interest, but now someone owes us money. So I'm glad we did this one. So it says on the last day of the year, Sufin Materials Corp had a balance in notes receivable of $25,000. There's the principal, which represented a 6-month, okay, really not applicable, 6% note. There's my rate. Received from a customer on September 1st. That's going to be used in my time calculation. Okay, so this is one we just talked about, except this time it's from the other side of the house. Rather than us owing money to somebody, somebody owes us money. So we're still going to do principal times rate times time. That's not changing, but it's going to be interest revenue this time that we need to accrue. So let's figure out the amount. $25,000 was the amount of the principal. The rate was 6%. That was given. And this goes back to Brandy's question. The hardest part of this is figuring out that time. I'm going to circle the T. The time is how much time has passed since the date you signed the note and the end of the fiscal year. Well, we signed this, I circled it here, on September 1st. So get out your fingers. It's not embarrassing for me to get out my fingers. September, October, November, December. I get 4 months, 4 out of 12. It has nothing to do with the fact that this is a 6-month note. It's how much time has elapsed. So the last part of this is 4 months. And for your notes, the way we got 4 was 4 months have passed. September, October, November, December equals 4 months. Since this is an annual rate, it will always be over 12. Do it backwards on your calculator. I'm going to do it right now, and hopefully this one, 4 divided by 12, don't round, times 0.06, don't round, times 25,000. When I did that, and you know that I transpose numbers often, so Giselle will double check me. When I did that, I got 500 on my calculator. Let's see if you guys get that. I got 500. So I'm going to write that down. I'll put it in color so you can see it. Give yourself a second to make sure you can compute that. This time, though, it's money owed to us. Notice the word receivable. So we're going to use interest receivable and interest revenue or interest income. I think your book uses interest income of $500. And I'm going to put another line in here so I can write down a description. This is to record the amount of interest due to us on the note receivable. So interest works both ways. If you have debt, it's going to be interest expense. That's what most of us can relate to. If we've loaned money to somebody and have them sign a note receivable, that's going to be money due to us. That's why the word receivable in the account receivable is used here. Questions on that? The main reason I chose this problem is for these unearned accounts that are coming next, because that's where students have trouble understanding the concept of this unearned account. It's brand new to us. Remember what we said in the lecture. Unearned accounts, unearned revenues, they're called. They're liability accounts. They're used when money is received ahead of when it's earned. So I hope at your young age, you guys haven't had to engage an attorney. But if you haven't yet, it's just a matter of time, because we live in this litigious society where people sue at the drop of a hat. The more assets you acquire, the more often you'll find yourself getting sued, unfortunately. So most attorneys, for a business transaction, they want money up front. In other words, if I need some legal advice on a contract, the attorney's going to say, okay, give me a retainer of $1,000. When I pay that to my attorney, that's a prepaid. It has value to it. When my attorney receives it, that's an unearned revenue for him, because that's money earned ahead of, or money received ahead of when it's earned. So let's read. It says, during the week ended June 7th, McCormick Media received $90,000 from customers for subscriptions to its magazine, Modern Business. So they would have put that in this unearned account. Okay, and they told us it was unearned subscription revenue. So I'm going to write that up here. Unearned subscription revenue. I want to remind you that an unearned account means it is a liability. Liability accounts look like this from the rules of accounting that we learned. And so letter B says they received $90,000. They would have put that in this unearned account and also in cash. The adjustment is what this chapter is about. So I'm going to keep reading. It says on December 31st, that's the last day of the fiscal year, an analysis of the unearned subscription revenue shows that 60% were earned. Okay, well, when it's earned, I need to reduce this liability by 60%. In other words, they've done 60% of the work that they promised. What we're recording in this chapter is the adjusting journal entry. So when I do the math on that, 90,000 times 60%, I get 54,000. Let me put that in a color. We're going to take it out of the unearned subscription income, and we're going to put it into some kind of a regular old revenue account. They probably just call it something like subscription revenue. So I'm taking it out of the liability account and putting it into the regular old revenue account. So visually with the yellow, you can see what's happening. However, we know that the only way that these transactions get into the accounting records is through the journal entry process. So let me come out to the side here and write down that journal entry. What we just did is we decreased this new liability account called unearned subscription income, and we put it into the regular old revenue account called subscription income for $54,000. To record 60% of the monies earned. I want to show you one more thing, but I also want to give you the chance to ask questions. So what would be left in this liability account is anything that still has not yet been earned, right? Another way of saying that is what's going to be left in there is the other 40% that hasn't yet been completed. Let me put in another line so I can show you that. If I foot this T account, then I'm going to take 90,000 minus 54,000. What's left in the unearned account is the uncompleted work. It's still a deposit. It's still sitting in there. Those unearned questions are a source of confusion, I personally believe, because we're not used to seeing liabilities without the word payable. We haven't had any up until now. And so I think that's where the confusion comes in. Remind yourself that this is a liability account. Why? It's money that we received ahead of when we earn it. We'll do maybe one more related to that unearned account to give us a little bit more practice, and then we'll go jump in and start that worksheet. So letter C, unless you guys have questions, if you have questions, please, please, please ask. All right, let's do one more, and then we'll move on to our next one. It says on November 1st, Perez Realty rented a commercial building to a new tenant and received $37,200 in advance to cover the rent for 6 months. Okay, well, that is money received ahead of when it's earned. We're going to use an unearned account. Remember that unearned accounts are liabilities. Our rules for T accounts on liabilities are minus plus. So it says we got it on $37,200 and we got it on November 1st. So that's when we got it. That's not what this is about. This is about doing the adjustment for what's been earned. So we're going to keep reading, and I'll go back and put a couple more notes on that one. That's just where it's sitting right now. It says on November 1st, they rented a commercial building to a new tenant. They got $37,200 in advance to cover the rent for 6 months. This is 6 months rent. What we're supposed to do on the adjusting entries, we need to adjust this account to what it should be. So the goal is to figure out how much has been earned. We'll figure that out, and to take it out of the unearned account and put it into a regular old revenue account, maybe something like rent income or rental income. So the big question is, how much of that money that they received up front has now been earned? Well, it was for 6 months and they got it on November 1st. I'm going to use my fingers again. November and December have now passed. 2 out of those 6 months have now passed. So here's the way I'm going to do it. 2 out of 6 months have passed. So when you do the math on that, I'll go ahead and let Excel do it. 6 times 37,200 is my formula. When you press enter on that, you should get the amount of that rent, which has now been earned because the time has passed. When I do that, I got 12,400. I'm going to take it out of the liability and put it into the regular rental income. So let me write that journal entry down. We're visually looking at it. What we just did is take it out of the unearned rent, which is a liability account, and put it into the regular old rental income. I'm going to leave myself a description because I'm leaving a historical document of what happened to record 2 out of 6 months of revenue. And the way we got 2, November and December, have now been earned. Practice that on the homework. You can't do enough of these. So you guys will have a 10-point test question on the test, I'm fairly certain. It'll be very similar to this last problem. So what I'm going to have you guys do, in the interest of time, we've talked about every single one of these. In the interest of time, I'm going to have you try that at home, and I'm going to send you the solution. I'll send it out later today. So we've done all the examples of transactions involving all the adjustments we talked about. As a final recap, you guys try 12-1B. It is a 10-point test question. So someplace in your notes, I'd highlight it, tag it, flag it, whatever you do when you know something's going to be on the exam. You're going to try this problem, and I will send you the answer to that later today. Let me stop for a second. That's a lot of new material to cover. Any questions from anybody? Okay, my goal today was for you to be able to do 100% of your homework. I don't think I showed my screen yet. Let me come back in there. And so in order for that to happen, I need to show you a worksheet. So we're going to go to the second day for chapter 12. There's one worksheet. I'm trying to pull it up here. So go ahead and grab that. And what I did right before class started, I gave you guys the problem on the first tab. I gave you all the wording. And what we're going to do is we're going to do an example of one worksheet. And I put it together for us. And in the interest of time, I dropped in the trial balance columns. So if you go back and you take a look at the wording, they told us all the balances and whether they were debits or credits. In the interest of time, I completed the trial balance columns, because what we want to focus on is how to do these adjustments. This will be another great set of practice. And then can you remember how to complete the worksheet? I want to make sure that we have a chance to do that. Again, a reminder, and then I'll take questions before we start. A reminder, the mechanics of this worksheet are identical to what you've learned in chapter 5 with one exception. And that one exception is how we're going to show the inventory adjustment on here. So you'll see me probably highlight that one. Other than that, everything else mechanically on the worksheet is going to be the same. So let me stop for a second, see if you guys have questions, and ask away. All right. First one, and again, if you guys have trouble reading this, because I know it's really small, just go to the previous tab and you can read these adjustments in bigger print. I'm just trying to avoid going back and forth to not drive you guys too crazy. All right, first one, it says merchandise on hand on December 31st is, and I think it says 15,840. I'm going to make something bigger on my end so I can see it. All right, inventory, what do we remember about that one? 2 adjustments, 2, take out the old, put in the new. So I'm going to highlight this one because this is the one that can throw people off because it is new on a worksheet. So step 1, take out the old. Okay, well, I'm looking at a yellow inventory number of 16,985. Step one, get it out of there. So I'm going to 16,985, I'm going to credit the inventory account, and the debit is going to go to that dummy account called income summary. So put that credit in here to merchandise inventory, and then go find the income summary. Sometimes it's at the bottom, sometimes it's in the middle. So here it is, income summary. And I'm going to go grab that number because I can't remember what it was, 16,985. And I'm going to make this one yellow also because we're not used to seeing income summary on a worksheet. So we are halfway done with that. We took out the old, it's zero. If you were to do a little T account for inventory right now, there'd be a zero in it. And now we want to put that new inventory back in, 15,840, 15,840. And I'm going to go down to income summary. And I'm going to write in that same number, 15,840. Now here's the new part. Normally, when we do this worksheet, we foot across and we get an ending number. This is the only account where I want you to carry over both numbers to the adjusted trial balance. Okay, so I'm going to write a note in here. Do not net income summary. What that means is when you foot this across, carry both numbers over. So this is what this looks like. This is the new mechanical part. Everything else is going to be identical. So this is an income summary. It's a brand new account on the worksheet for us. We've never had it on a worksheet before. Its purpose is to temporarily hold the income statement numbers. In fact, not only do I want you to carry it over to the adjusted trial balance columns, I also want you to carry it over to the income statement columns. So another note, carry both over to income statement. Why? Because you saw at the start of class, this is going to be necessary on the income statement to compute that big chunk called cost of goods sold. So carry them to both places. Do not net, carry them over. I'm going to highlight that too. So we're done with A and B. We took out the old and we put in the new. And the income summary line is the brand new mechanics. Do not net them, carry them both over to two places. Carry it over to the adjusted trial balance and also carry it over to the income statement. That's the only line item that is the exception to the rest of the mechanics that we've already learned. Okay, and again, contractors are here if you guys hear buzzing and noise in the background. I was not expecting them today. That's why I had to fly out of my chair. They were not supposed to be here today, so I apologize. All right, let's keep going. Letter C. During the year, the firm had net credit sales of $160,000. Past experience dictates that 0.8% of these sales will result in uncollectible accounts. Okay, what do we do there? We're going to put an expense on the books, and we're going to adjust the allowance account that may be on the books. We'll go look in a minute. But in any case, it's 160,000 times 0.8%. Let me go find the uncollectible accounts expense. It's near the bottom. And that calculation is going to be the 160,000 in net credit sales times 0.6%. If you guys don't have a percentage key, it's 0.006. So go ahead and do that. Giselle, you can check my number. I got 900 and, hard for me to read. It's probably hard for you to read too. Let me scroll up. I'm having trouble finding it. Oh, that is not what I got. I got something else if this is the correct one. So let me try it again. 160,000. Oh, 0.8%. That was the problem. 0.008. That looks better. 1,280. Okay, so if you missed that, let me see if I can make this a little bit bigger so it's not so bad on your eyes. So if you missed that, if you look at my formula bar here, you'll see 160,000 times 0.008. That means that realistically, we expect $1,280 worth of credit sales to not be collected. So we debited the new account. Let me put letter B in here. And we'll credit a brand new account. Wait, it'll be right below accounts receivable. It was that new contra account, and it's for the same amount. Okay, so there we go. We debited the expense, we credited the allowance, and that was actually letter C.
Oh, excuse me, Professor.
Yes.
On letter C, and I could be just reading this wrong. It says 0.8.
Yes.
But we put 0.08.
Okay, Brandy, good question. I'm glad you asked. 0.8% here is equivalent to move the decimal 2 to the left if you don't have a percentage key, 0.008. Thank you.
Okay,
0.8% here. This is what they are reading to you. If you don't have a percentage key, it would be 0.008 because you would move the decimal 2 to the left.
Okay, thank you.
I was
just like, what?
Yeah, so if you have a percentage key, Brandy, on your calculator, because a lot of us do, you don't even have to mess with that. You can just put 0.8%. Let me show you how that would work if you have a percentage key. So here's my formula. If you have a percentage key on your calculator, you can literally put in 0.8% and it will calculate it to be the same amount. So hopefully that makes sense. I need to change that to letter C, by the way.
Yeah, I guess I was just confused because they wrote 0.8 versus like on H where it just says 9%, and then we know that we fix it.
Yeah, they go back and forth. Sometimes they'll actually write out the percentage and sometimes they'll write it in words. You have to be really careful to read it carefully.
Okay.
Yeah.
Thank you.
You're welcome. Any other questions on the first 3 adjustments? Okay, then letter D is an old one. It says on December 31st, an inventory of supplies. Now remember, this author, just like in chapter 5, will go back and forth between how much was used up and how much was on hand. He's going to change the wording. And so what we always need to figure out, if they don't give it to us, is how much has been used up. So let's go up to the supplies account. Up top here on line 14, unless you changed line items. Let me make this a different color so we can see what's going on. I'll make it orange. There's 750 in the books right now. And what the author said is there's 245 on hand. So I got to compute it. And remember, he'll go back and forth. So you got to read carefully. He's telling us 245 is on hand. So on your calculator, 750 is what's in there now. And we should have 245 on hand. So press enter. And I got $505 used up. So we need to go hit the expense account for, go put that in the freezer.
No. Oh.
Please. Sorry for the interruption. Really apologize for that. We need to go put that in the supplies expense account. So let's go down to supplies expense. and put that right here. Okay, that's an old one. This time he told us how much was left. So we had to figure out how much had been used up. That's an old one. We debited supplies expense and we credited supplies. Okay, then letter E. It talks about the firm buying a 1-year insurance policy on July 1st. Well, that should be in the prepaid account. Let's go find it. Here's the prepaid account. I'll make it a different color so we can easily see it. It's going to be in this turquoise color. There's $2,400 in there. And what it says is that was a 1-year insurance policy bought on July 1st. So here's what we need. We need to know how much has been used up as of December 31st. So I'm not afraid to get my hand out. July's gone. July, August, September, October, November, December. 6 months of that policy's gone. July, August, September, October, November, December. 6 out of 12 months are gone. Another way of saying that is half. Half has been used up. So I'm going to take half of that amount out, $1,200, and put it into the expense account. Since it's prepaid insurance, we're looking for insurance expense. So let me go find that and put it in there. That's an old one. So when we have prepaids, we need to go make sure that the prepaids are up to date. That transaction transferred the used amount or half out of the prepaid and into the expense. F and G are on depreciation. In the interest of time, I'm going to skip those, but I will send you the answer to this. Let's skip F and G because we know how to do depreciation. The one that I want to jump down to is letter H, because again, this is new for us. Debt and the accrual of interest is new to us. So I want to skip past the depreciation one, and I want to go to letter H. And letter H says on October 1st, the firm issued a 6-month note payable. Okay, if you go look on the debt accounts, I'm looking at the liability accounts and I scroll back over, here's that note payable that they're talking about. Whenever there's payables, there's going to be interest. Okay, so they're talking about that $4,000 note in letter H. So it says they issued it on October 1st. It was for $4,000, which we see 9% interest with the local bank. Okay, what do we need to do? We need to compute the interest. Since this is debt, we're going to be debiting interest expense. So I'm going to go find that. It's usually the very last account. We'll go see. Go find interest expense. It is the very last account here. And what we want to do is principal times rate times time. So as I read through that, the principal was $4,000. The rate is 9%. What everybody messes up is the time. So the time given in H is from October 1st to the end of the year. October, November, December. 3 out of the 12 months have passed. In other words, what we're doing is taking this annual rate and turning it into the portion of the year that's gone by. October, November, December, 3/12, not 3/6. I'll get probably 10 emails this weekend, and they'll say, I can't figure this out. I keep multiplying it by 3/6. It's always 12 on the bottom if you're talking about an annual rate, because as long as I've been on this earth, there's been 12 months in a year. So go ahead and pop that into your calculator. And I got $90. Okay, thank you, Giselle. The credit is going to go to interest payable. That's going to be up in the liabilities. Let's go find it. There it is. Put the same $90 that we just computed. Okay, let me stop. Any questions on A through H? Okay, we'll do I and J and K, and then we'll call this a wrap. Again, I'll be sending you a completed. Letter I says, at year end, they owe $14.50 in salaries. Okay, at year end, the firm owed their employees some money. What's going to happen on the rest of this problem? Not only will we have to put the wages on the books, J and K will talk about the taxes being placed on the books. So let's take care of the wages first. We're going to go to Salaries Expense, and we need to put the rest of the employees' pay on the books. So I says we owe our employees $1,450. Because we owe them that, we're going to use salaries payable. So I'm going to scroll up to the liabilities now. I'm going to put salaries payable on the books for letter I for the same amount. So if you missed that, we debited salaries expense and we credited salaries payable. And then the last ones, J and K, deal with those payroll taxes. So I'm going to find payroll tax expense. Here it is. And I'm going to call this J and K. I'm going to do one big journal entry. I'm going to put a green box there. I don't know what payroll tax expense is going to be. It's going to be the sum of these 4 payroll taxes. So I'm going to go in and calculate them one by one using the rates that they gave us. They gave us all the rates we need. So let's go up to all those liability accounts that we learned about when we did chapter 11. And we're going to go calculate them. So the first 2 your author calls J, and the last 2 he gives you the rates in K. Don't ask me why he did them in 2 journal entries. I think it was poor judgment. And again, the author's a good friend. I'm not gossiping. I have said that to his face. Don't teach them one way in one chapter and split it up in the next chapter. So here we go. All we got to do is let the computer calculate it. There was $14.50 in wages, and the Social Security rate was 6.2%. So Brandy might have a percentage key on her calculator. She could just type in 6.2%. Others may not. You need to turn it into a decimal. So I'm showing you the option in case you don't have a percent key. And then Medicare, we're going to take that $14.50 and type in the Medicare rate your author gave us, which is 1.45%. And when I do that, I got 2103. And then FUTA and SUTA are in this last one. FUTA is 6%. So once again, the wages of $14.50 times 0.6%, which is 0.006. And then SUTA, they live in a cheaper state than we do because they gave the SUTA rate at 5%. Ours is higher than that here. So I have 4 green numbers there. I'm going to give you guys a chance to look at those. And then what you want to do is on that payroll tax expense line item toward the bottom that was green, we need to add those 4 up. Okay, so I'm going to go down to payroll tax expense here, and I'm going to sum up all 4 of those. So 89.90 was the first one, 2103 was the second one, $870 was the third one, and $72.50 I think was the fourth one. I'm going to add those all up. Give you guys a chance to add them up. And when I press enter, I got 192.13. Giselle, if you used a summation on Excel, you'll be a penny off. So rounding issue. And the rest of the worksheet would be identical, which means we would simply add across. So I'm going to refresh your memory on how to do that for a couple of line items. And then again, I'll send you this completed worksheet done with all the adjustments. We skipped over F and G on the one that I send you. They'll all be done and the worksheet will be completed. So your next step would be to sum up the adjustment columns and make sure they equal. Let me get rid of these adjustments here so I can show you my screen. So the next step then, just like we did on the Chapter 5 worksheet, would be the horizontal math. So I go all the way up to the top. Cash didn't change, bring it over. And accounts receivable didn't change, bring it over. I wanted to show you this contra account, though. It's the first time we've dealt with the contra account. Remember that contra assets start with the credit balance. They increase with the credit balance. We got to add those across. So on our calculator, 600 that was already there plus 1280 would give you 1880. The last thing I wanted to show you that is new, again, we talked about this earlier, the inventory account. Do you see how these two cancel each other out? And what you're left with sitting in inventory is the 15,840, which is the new inventory. That is what should be sitting there. And the supplies, we started with 750 and it went down by 505. We're left with 245. That number should look familiar. That's the amount of supplies that were on hand. So we know we've done that correctly. And the rest of it, you guys would be able to do from here. Prepaid insurance, we're left with 1,200. Store equipment didn't change. It would be 6,000. We didn't do those entries for depreciation. So that's probably where I'm going to end this. My goal was to be able to definitely go through all the adjustments, which we had plenty of time to do that, and to give you an overview of the mechanics of that worksheet. The rest of the mechanics are identical to what you learned in Chapter 5. So what I want you guys to do this weekend, we talked about this at the start of class. I know Chapter 12 is not due this weekend. I know that. In your best interest, if you can at all fit it in this weekend, and I realize that we all balance school, life, kids, jobs. I know we got a lot going on. But if there's any possible way you can do your best to finish up Chapter 12, then all we'll have left next week is one chapter, Chapter 13, and the rest of your time you can devote studying for the exam. So let me stop. There was a lot of stuff in there. Any questions on anything you saw or anything you heard me say?